All right, let's dig into Norfolk Southern's latest earnings report because this one was a real head scratcher. You see, the company actually beat its profit estimates, but then the stock took a nosedive. So, what exactly did Wall Street see that the headlines missed? Let's break it all down. So, yeah, this is the central puzzle we're trying to solve. The railroad giant comes out, posts a better than expected profit, and the stock drops. It's a classic case where that big, shiny headline number just doesn't tell you the whole story. There's clearly something else going on under the surface. And to figure out what the market was really focused on, we have to start with the results themselves. So let's just get right into the headline financials from this quarter's print. Okay, so what you're looking at here is kind of a split decision. On one hand, you've got the adjusted earnings per share, or EPS, coming in at 330. That's a nice beat over what analysts were expecting. But then you look at the top line, the revenue. At $3.1 billion, it was just a hair under expectations. Now, it's a small miss for sure, but as you'll see, it was a critical one. Meanwhile, their operating ratio, which is a key measure of efficiency, did get better, so that's a definite positive. Right, so that 11-cent beat on EPS, that's nothing to sneeze at. On the surface, the bottom line looked pretty good. And this is the number that a lot of the headlines were grabbing onto. It shows you that management is definitely doing a good job managing their costs. But you and I both know the market is always looking forward, not backward. And here's the disconnect in action. Despite that solid beat on earnings, the stock slipped over 1%. What does that tell you? It tells you investors weren't really celebrating the cost control, they were worried about something else. That tiny little revenue miss was actually a signal of a much bigger problem. So let's peel back another layer here, because to really understand that stock drop, we've got to look behind those headline numbers. We need to get into the nitty-gritty of the operations and what management was saying on their call. And when you break down the revenue, it all starts to make sense. Look, their merchandise segment was a bright spot, no doubt. Volume was up 6%, driven by things like cars and chemicals. But, and this is a big but, the higher value stuff, intermodal and coal, was weak. Intermodal volume dropped 2%, and with coal, even though volume was okay, the revenue they make per unit fell 7%. So you're seeing a shift toward lower margin freight, and that was a major headwind for them. And there it is, this quote from the CEO, Mark George, on the earnings call. This is basically the smoking gun. He's admitting, point blank, that their massive, recently announced merger with Union Pacific is already causing problems. Competitors are getting aggressive, trying to lock in business now before the whole landscape changes, and they're poaching customers. You can bet that's hitting that weak intermodal segment especially hard. So what's management's response to all this? Well, they're doubling down on what they can control, their costs. They went and raised their productivity target to $600 million by 2026. This is a very clear signal to investors. They're basically saying, hey, we know the top line is getting messy, but we are going to be absolutely hyper-focused on efficiency to protect that bottom line. And this all brings us to the bigger picture, because this quarter really wasn't just about the numbers. It was about the huge shadow being cast by that pending Union Pacific deal and all the other pressures in the industry right now. So when you put all the pieces together, you can really see why investors were so nervous. You've got this massive regulatory uncertainty around the merger. You've got management themselves admitting it's already costing them business. You've got that ongoing weakness in coal. And, to top it all off, their main competitors, CSX and Union Pacific, actually put up stronger numbers. That suggests Norfolk Southern might actually be losing ground. Suddenly, that earnings beat gets completely overshadowed by this long list of very real risks. Okay, so what in the world does this all mean for the stock moving forward? Let's try to distill everything we've talked about into an outlook, and maybe even a potential trade idea for the next quarter. Here's how we see the tug-of-war playing out. The bull case is pretty straightforward. Management is doing a great job on costs, and hey, if that huge merger actually gets approved, the long-term benefits could be enormous. The bear case, though, is all about the here and now. That merger uncertainty is a real drag on revenue. Key markets are soft, and there's absolutely no guarantee the deal even gets past the regulators. And right now, it feels like those near-term headwinds are winning the fight. So for the next call, we're slapping a market perform rating on Norfolk Southern. The company is just caught between its own solid execution and these really big external headwinds. That probably means the stock is going to trade sideways for a while, at least until we get more clarity on that merger. Now, an interesting way to play this could be a pairs trade. You go long CSX and short Norfolk Southern. That's a way to try and isolate that competitive pressure story. The big question for next quarter is, can they fend off these attacks long enough to make this merger happen? This is not financial advice.